Today, we're diving into a type of financial product that has pulled in billions of dollars by making a promise that's almost too good to refuse. We're talking about the Covered Call ETF Trap.
You can see the appeal, right? For anyone looking for a steady stream of income, especially if you're in or near retirement, this looks like a dream come true. A high yield, paid out every single month like a paycheck. It seems to solve a huge problem for investors. And it really gets to the heart of the issue. This is the key question we need to answer. Is that monthly check truly income, or is there a hidden cost? Are you trading away your long-term growth for cash today?
So let's start with why these products, the ones with tickers you probably recognize like QYLD and JEPI, have gotten so incredibly popular. In today's world, finding reliable, high yields is a real challenge, and these ETFs step in and seem to offer the perfect solution.
But to really judge these funds fairly, you can't just look at that big yield number. We have to pop the hood and see how the engine actually works. So let's break down exactly where that income is coming from.
At its heart, the strategy sounds pretty straightforward. The fund buys a bunch of stocks, usually tracking a big index like the S&P 500. Then it turns around and sells what are called call options on those same stocks. The money it gets for selling those options is called the premium, and that's what gets passed along to you as your monthly distribution. And this right here is the most critical distinction to understand. Real investment income, like a dividend, is a piece of the new wealth a company creates through its profits. But the option premium from a covered call, that's something totally different. It's a payment you get for agreeing to sell away the potential for your stocks to go up in value. It's not creating new wealth, it's just trading future growth for cash right now.
So let's just put a fine point on it. That monthly payment isn't some kind of free money being spun off by the companies in the portfolio. What's really happening is you are systematically selling off your chance to participate in the market's upside. You're cashing in your future growth.
Okay, so now that we know how it works, let's look at the numbers. Let's see what the long-term result of this strategy has actually been. The historical data really paints a clear picture of this trade-off.
We'll start with QYLD, which is probably the most famous of these funds. Over the last decade, if you look at its total return, that's the distributions plus any change in price, it comes out to 7.5% per year. But look at a simple S&P 500 index fund, SPY. It delivered 12.8%. That is a massive difference, and it really shows you the price you pay for capping your upside when the market is climbing. And you know, this pattern isn't just a one-off. It holds true for newer, very popular funds like JEPI. Over the past 5 years, JEPI has returned about 10.7%. That's not bad, but it's still trailing the S&P 500's 16.5% by a pretty wide margin. The data is consistent. These strategies tend to lag the overall market.
And this just confirms that the problem isn't with any single fund. It seems to be baked into the strategy itself. If you look at other funds like PVP and XYLD, since they launched, they've underperformed the S&P 500 by over 600 basis points. That means they've lagged the market by more than 6 percentage points every single year. That's a huge drag on your ability to build wealth.
Now, let's talk about the risk you're taking for that return. This strategy creates a risk-reward profile that is frankly pretty lopsided, and not in a good way for the investor.
So here's the fundamental problem. When the market goes down, you're pretty much all in. That little premium you collect might soften the blow by 1 or 2%, but that's nothing in a real downturn. But when the market rips higher, your gains are completely capped. You don't get to participate. It's full downside, limited upside. And on top of all that, the distributions are often not very tax-friendly, which can eat into your real returns.
And as if that wasn't enough, there's the cost. To run this active option strategy, these funds charge an average of 0.29% a year. Compare that to a basic S&P 500 index fund at just 0.03%. We're talking about fees that are almost 10 times higher. That's another hurdle your returns have to overcome year after year.
So, if these high-yield ETFs have so many drawbacks, what's a better approach? Well, it might not be as flashy, but the source material points us towards some classic, time-tested strategies for building wealth without giving up your growth.
Really, the alternative is about getting back to basics, building a simple, balanced portfolio, something like the classic 60% stocks and 40% bonds, using cheap, broad market index funds. This approach lets you capture the market's growth and allows the incredible power of compounding to work its magic over the long haul. And when you look at the long-term results side by side, it's pretty eye-opening. Historically, the S&P 500 has returned around 10% a year. A balanced 60-40 portfolio is closer to 7%.
and a covered call ETF like PBP significantly lower. This just shows you what a big difference giving up that upside can make over time.
This is just a fantastic rule of thumb to keep in mind for any investment. Whenever you see an unusually high yield, it should be a signal to dig deeper. It often means there's a higher risk or some kind of hidden cost, just like we've seen here.
So, we'll leave you with this one powerful question to think about. When that monthly distribution from a covered call ETF hits your account, are you actually getting paid, or are you the one who's paying by selling off a piece of your financial future?
We hope this breakdown brought some clarity to how these complex products really work. If you found this explainer helpful and want more deep dives to help you make smarter financial decisions, please do us a huge favor and hit that like button, and be sure to subscribe to the FinBot Insights channel.